Welcome to the reading of the August 2026 Monetary Policy Statement. On August 13th, 2026, the Monetary Policy Committee of the Bank of Uganda maintained the central bank rate, CBR, at 9.75%. In the 12 months to July 2026, annual headline and core inflation both averaged 3.3%, supported by prudent monetary and fiscal policies. However, inflation picked up gradually in the recent months, partly due to supply-side pressures. Annual headline inflation rose to 4% in July 2026, up from 3.7% in June, driven by higher energy, fuel, and utility inflation and rising food crop prices. Energy and fuel utilities inflation increased to 14.9%, up from 11.9%, largely reflecting higher petroleum product prices combined with a slightly weaker shilling. Food crop inflation rose to 1.6%, up from 0% in the month of June 2026. The current inflation data does not show a broader price pressure spreading through the economy as a result of the increase in the oil prices. Indeed, annual core inflation held steady at 3.4% in July 2026, while services inflation eased slightly from 4.9% to 4.8%. The inflation outlook has improved compared to the previous forecast round, mainly due to lower international oil prices relative to their May 2026 peak. However, international oil prices have remained volatile, blurring the near-term outlook. Exchange rate pressures have also eased, with the Uganda shilling stabilizing after depreciating in the earlier part of the year. As a result, the inflation forecast has been revised downwards, with core inflation projected to average between 4 to 4.5% over the next 12 months, and headline inflation projected to average between 5.5 and 6% over the same period. Of course, there are risks to this outlook, and they broadly remain tilted to the upside, including prolonged inflationary surges, which would promote major central banks to raise interest rates, thereby increasing depreciation pressures on the shilling due to capital flight to safety. Also, we have escalating geopolitical tensions, which could disrupt global supply chains, push up international oil prices, and raise domestic energy and transport costs. In addition, adverse weather conditions could reduce agricultural output and drive up the food prices. Also, a stronger positive output gap, which could generate additional demand-side inflation pressure, is the other risk. The downside risks that could ease inflation include favorable weather conditions that would improve agricultural output and food supply, weaker domestic growth, for instance, if prolonged conflict in the Middle East weighs on the global growth, thereby dampening domestic demand and inflationary pressures. The Ugandan economy has remained resilient amid persistent global headwinds. Economic growth in financial year 2025/2026 is estimated at 6.4%, supported by the strengthening private sector credit that further increased household consumption and investment, as well as government spending. Credit conditions continue to improve, with both demand and supply of credit increasing, supported by easing lending rates and improved asset quality. The external position has also strengthened, with the overall balance of payments recording a surplus of $2.4 billion US dollars in the 12 months to June 2026, resulting in a similar increase in the foreign exchange reserves over this period. Growth is projected to accelerate to between 7 and 7.5% in the financial year 2026/27 and around 8% over the medium term. This projected growth is supported by prudent monetary and fiscal policies, remittances inflows, higher investment and exports boosted by the oncoming oil production. In addition, the continued implementation of the government's tenfold growth strategy is expected to accelerate growth in the strategic sectors and promote exports through value addition and increased agricultural production. Nonetheless, the balance of risk to growth outlook remains tilted to the downside, and the key downside risks include: 1. Energy prices and supply chain pressures remaining elevated and uncertain and could continue to affect the global growth, constraining external demand, and could also disrupt trade and investment flows and weigh on economic activity. 2. Increasing protectionism and trade disruptions could worsen the supply chain and constrain domestic activity. And thirdly, the residual effects of the recent health-related travel advisories and Ebola-related restrictions, which could dampen tourism and related services activity. On the upside, growth could exceed expectations if: 1. Investment in the extractive sector is stronger than anticipated. 2. There is a de-escalation in the geopolitical tensions resulting in the better global growth outlook, thereby lifting external sector demand. And thirdly, robust credit flow and government's continued thrust on infrastructure stimulating investment activity more than is currently projected. So while inflation remains modest, the risk that higher food, fuel, and other input prices will translate into a broad-based increase in inflation persists. Therefore, clarity on the inflation outlook, particularly its path and the underlying drivers, is needed before considering further policy action. Given the elevated risks of energy-related price shocks feeding through domestic inflation expectations, a cautious monetary policy stance remains appropriate. Against this backdrop, the MPC maintained the CBR at 9.75% to preserve price stability while allowing time to assess global developments and their implications for our inflation outlook. The CBR band is maintained at plus and minus 2 percentage points, while the rate discount and the bank rate remain at 3 and 4 percentage points above the CBR, respectively, resulting into a rate discount rate of 12.75% and a bank rate of 13.75%. The Bank of Uganda remains committed to promoting price stability in support of socio-economic transformation. Future monetary policy decisions will remain firmly data-dependent, guided by the evolving outlook and balance of risks. The IMF Article 4 staff report did commend the central bank for its policy actions, both for monetary and the financial sector, and I have nothing more to add to that. I think they were spot on. Now, of course, the issue of debt, we need to understand why has the level of debt gone up. The level of debt has gone up because of the investment that government is undertaking, including in evacuating the oil from the ground to Tanga for exports, and also other development projects. And if you look at the solvency, that is, how does it compare to our GDP? I think it is still sustainable and is regarded at the moderate risk of distress. And where we have a challenge is certainly the debt servicing indicators, including the ratio of debt service to total tax revenues. I think that's where the concern is. And then if you look at that, it is in the mid-40s. So it means that for every 1 shilling that is collected by the Uganda Revenue Authority, about 40 or so cents goes to servicing debt. And that is really quite impactful on other social expenditures and investment. Now the question is, how do we reverse that? That can only be reversed through increased government fiscal consolidation. And indeed, if you look at the medium-term projections of the fiscal framework, we are seeing a fiscal consolidation. We are expecting the fiscal deficit to come down to as low as 3% by the time we get to 2030/2031. So there's that downward path. We then should also improve those debt servicing ratios. So I think if we go with what's in the medium-term framework, medium-term fiscal framework, we should be able to reverse those concerns on debt. But the debt has gone to help us to develop some of the projects which are necessary to support the tenfold growth. So what's important is how is the money the government is contracting being utilized? And I think with those investments in there, we should be able to reverse those concerning debt service indicators. Oil revenue, the yuan. You recall some time, I think about a decade ago, the Chinese yuan was made a reservable currency, part of the special drawing rights by the IMF. So what that meant was that countries could hold the yuan, and it could also constitute a measure of their reserves. Now, we have a reserves management policy that determines how do you hold your reserves. There's what we call strategic asset allocation. It guides you on how, in the different currencies where you hold your reserves, largely based on your liabilities, right? You match your assets with your liabilities in terms of currency so that you don't get currency mismatches. There's no point of holding huge amounts of your reserves in pounds when your liabilities are in dollars, right? Because you don't want to expose yourself to any exchange rate movements, right? So that's one of the criteria. The other one is to do with the trade as well. Now, in the strategic asset allocation, of course, we have the yuan in that as well. But again, like we say, you need to look at where are your liabilities more denominated, what currency? And in the case of Uganda, it's still the US dollar. So you find that the bulk of our currencies, of our reserves, are held in US dollars. Now, certainly as the role of the Chinese yuan grows, in terms of if we increase our borrowings in Chinese yuan, if we can convert some of the US dollar debt that we contracted from China into yuan, then there's every incentive for us to increase the amount of yuan in our reserves. So there's that matching that you have to be mindful of. You don't want to be caught in these movements of the exchange rate, then you incur losses. So yes, the yuan is part of our reserves toolkit, but the proportion is still very, very small, largely because of what I've just mentioned to you. Yes, we've maintained the CBR at 9.75% for some time. And again, this has been guided by our analysis of the outlook, not only of the Ugandan economy, but of the global economy, and also the balance of risks, that where are the risks tilted to? Now, to the extent that we are trying to ensure that inflation remains well contained, we see that any risks that are tilted upwards can weigh in on our decision in terms of the policy rate. And if you recall, we have always been telling you in the monetary policy statements reading that our risks have likely been tilted upwards, particularly the geopolitics and its adverse consequences that could lead to higher inflation. So, notwithstanding the fact that there were certain situations that were favorable for lowering the CBR, the tilted risks on the upside were considered. And also the uncertainties, particularly in the global outlook, weighed in quite significantly to make us hold the CBR at 9.75%. Now, you allude to the issue of the cash reserve requirements being now the tool we're using. I don't think that is entirely correct because I think this year we only raised the CRR by 150 basis points, I think. It was either end February or early March, I don't recall the date well. And likely it was because of what was happening. It was triggered off by the conflict in the Middle East, where the US and Israel went into war with Iran, and we saw the oil prices begin to edge northwards. And if you look at what happens to the oil prices, what happens to the exchange rate, they seem to be moving in the same direction. So we will begin to see pressures in the exchange rate. That's why I said in my statement that there were depreciationary pressures that were witnessed in the earlier part of the year. At the same time, we had significant structural liquidity in February. Now, when you change the policy rate, the impact is not as quick as a change in the CRR. A CRR is immediate, depending on the maintenance period. If you decide to change the CRR by 150 basis points, that means you are sucking in liquidity. I think this time we sucked in like about 700, 800 billion by that action alone. So it was much more effective. And we've maintained it at that rate. And again, we did not know the duration of the conflict in the Middle East, because if you had to raise the policy rate, it means that you have a longer term view about the outlook. Now, since we did not know the duration of the conflict, it was much better for us to raise the CRR so that in case that conflict came to an end, it would be much easier to lower the CRR than to lower the CBR. So there were many factors that we considered. And right now, we do not know really for how long. We don't know the duration of that conflict. So that's why, again, there's a lot of uncertainty and in the outlook and also in the balance of the risks remain tilted upwards. Hence, we will maintain the CBR at 9.75%. Now, you correctly observed that the shilling dipped by 4.7%. And you're asking, at what level do we intervene? I think intervention is based on smoothing out excessive volatility in the shilling exchange rate movements. And I don't know, have we recently observed excessive volatility in the shilling? Not to the best of my knowledge. That 4.7 that you are looking at, I think, is year on year, if I'm not mistaken. And if the shilling has depreciated, it has depreciated in a smooth way. It has not been erratic. It has not been very volatile. And therefore, it has not necessitated any intervention. So I think that's what I would have to tell you on the intervention. Hakim, why have a single currency? I think it is a common common question. I think just to lower the cost of doing business, because what is a currency? What is a common market about? The common market is about freely trading in goods and services, all right, lowering the cost of doing business, and a single currency can help us do that. That is really the main thing about this single, about this currency. Okay. And I think it's all linked to Dennis. Single currency 2031. This single currency is achievable if we can meet the convergence criteria. But of course, the convergence criteria is facing challenges in that we are not all evolving to the convergence at the same rate. Some countries are lagging behind. Then also, the recent global environment is affecting the speed at which we are realizing the convergence variables as required. And for a single currency to be meaningful, you need to have converged. Now, the question that we need to discuss is, what do we need to do to converge? And if we really want a single currency, how do we get to a single currency? There is what economists called, I think, geometric conversion. Is it geometric? Yeah, I think it's geometric, if I'm not mistaken. That if any two countries are ready, variable geometry, correct, variable geometry. If any two countries are ready and have met the criteria, they can begin with the single currency. And then you onboard those that are meeting the currency or the criteria. So you move from 2, 3, 4, as long as you're meeting the convergence criteria. Now, the challenge, of course, is that if we are waiting for everyone to meet the criteria, it might take long. So that's all I can comment about that currency. So the variable geometry narrative can quicken the process. Now, if we wait for everyone, it could actually slow down the process. We all need to be on a watch out. We need to beef up. We need to escalate our national cyber security awareness and build sufficient buffers against any cyber attacks. Because one thing that came out from that conference very clearly was that, look, you no longer have to defend that this is Bank of Uganda. I'm only mindful about Bank of Uganda cyber security. We all need to know what's happening in the ecosystem, because a problem in the telecom sector can significantly impact the central bank operations through the payment system. Okay? Likewise, if anything happens to the cyber security walls of Bank of Uganda, it could have serious implications for other sectors. So I think the key lesson from this is that we need to work as an ecosystem in ensuring that we have sufficient cyber security measures in place. Yes, AI is evolving, and there are guys out there, in as much as it is improving the way we do business, bring productivity gains and what have you, there have been guys who are planning to say, how can we use AI for the wrong reasons? So how do we lift our guards against those bad boys? So we all have to be on a watch out. It could affect the conduct of monetary policy, the stability of the financial sector, and what have you. But I think the way forward is threat intelligence sharing, what is happening, how do we bring everybody on board, and what do we have in place. And as we build our systems, we need to be mindful that security has got to be part of it from the word go. We don't just have to add it like a bolt-on. No, we have to be mindful of the security. We need to be investing time in finding out what is the latest security threat, the latest AI security threat, and how do we work with other partners in terms of containing it. So it's no longer, this is my territory. We need to work together as an ecosystem to fight it.